Good afternoon, everybody, and welcome to Property Perspectives. Today, I have with me Aulfat Bi, who's a capital allowance specialist. Now, we get asked about capital allowances on a regular basis, and I think this is because more and more of our clients are thinking about or are already using furnished holiday lets. So can we start off by asking you, can you give us some background to capital allowances and what they apply to?
Yes, it's good to speak to you, Neil, today, and to be invited onto this. So yeah, absolutely. So capital allowances are a form of tax allowance or tax relief that you can claim in respect of what's referred to as capital expenditure on certain business assets and certain types of properties, which is predominantly commercial properties, but you can also claim capital allowances on furnished holiday lets. The key criteria is that it needs to be capital expenditure, which means that from accounts perspective, you are holding it as what's referred to as a fixed asset. So it sits on your balance sheet. You will generate, say, rental income from it, or you use it as an owner occupier, such as maybe head offices, or you use it in your trade, maybe as a factory. And you also need to ensure that that expenditure is on what's referred to as commercial property, because residential property doesn't normally qualify for capital allowances. So commercial properties is pretty vast. It can be anything from office blocks, retail units, restaurants, hotels, student accommodation, care homes, etc., etc. But furnished holiday lets have almost like a special status where you can actually claim capital allowances on them, even though you get rental income from them. So they're a little bit unique. So providing you meet the criteria for furnished holiday lets, which is, oh, this is testing me, it's offered for let for over 210 days in the year. You actually let it for 105. You don't let it to the same person more than 31 days unless you've got an exceptional circumstance. And I'm sure there's a few other criteria as well. So as long as your residential property that you are letting meets that criteria, it's a furnished holiday let and you can claim capital allowances. So I guess the question is, well, what are they? They're a form of tax relief, but what are they? They are a tax relief that are given at different rates for different types of assets and fixtures within buildings. So if you take like a typical furnished holiday let, you will have mechanical and electrical installations in that furnished holiday let, such as your lighting, your small power. You might have some heating and ventilation, radiators, but you'll also have some other assets such as carpets or sanitary ware, hot and cold water, and you've probably got a whole load of, loose goods that were, so your white goods, your kitchen, washing machines, dishwashers, and you might have beds and furniture, etc. All of these assets will qualify for capital allowances. And what capital allowances allow you to do is to reduce your profits that are chargeable to tax. So companies can claim them and individuals can. So as long as you're a UK taxpayer, so you're within the charge of UK tax, you don't have to be tax paying, I hasten to add, but providing you're within the charge to UK tax, you can benefit from capital allowances. So they will either reduce your profits that are chargeable to tax, or you can use them to create a loss as well and carry those losses forward and offset them against the rental income from your property or from the income that you get from your furnished holiday lets up until you've utilised all of those capital allowances or losses. So they're lucrative, and they effectively allow businesses or individuals to write off the cost of an asset, not the entire asset, but they sort of try to put you in that position as if you spent some money on asset, you should get something back for it. And the way you get that something back is via a reduction in your profits, which means you pay less tax overall.
So how do you go about assessing capital allowances? You mentioned lots of things like radiators, sanitary ware, and then we've got, say, the fixed items, and then we've got all the loose items as well. So how do you go about making a claim? What happens when, say, the client doesn't have complete cost records? I mean, are cost records important?
So cost records are important. They're great to have because they will detail exactly what you've spent your money on effectively. And from that, a capital allowances specialist such as myself, we can have a look at it, we will review that documentation and identify what aspects of the cost you've incurred will qualify for tax relief, because not all of them will. And where they do qualify for tax relief, we will put it into the right categories for you. So we will put it into what is referred to the capital allowances pools, and there are various different pools for different categories of assets. We can do that utilising your cost information. However, if your cost information isn't in the right format, for example, you had a builder and he simply provided you with a quote and then you paid him the money and that's all that you got for him for undertaking the works, that's not going to be sufficiently detailed enough for us to have a look at and say X, Y, and Z qualify for capital allowances, because you haven't got that in that detail. So either we would go back and request that information from your, say, contractor, where that isn't possible for one reason or another. We can do cost reconstructions as well, using standard measurements and building rates, and we utilize quantity surveying techniques in order to review a building, have a look at it, work out what are the fixtures that qualify in that building, and undertake a cost assessment for those assets. So it's almost as if we do a cost reconstruction of the costs you have incurred on that property. So we can do that. And particularly where a client acquires a property, so this is called a purchase claim, you won't have any information on what the previous owner or another owner in the past incurred on constructing that property. So we do that by reference to the purchase price that the client has paid for the property, and we undertake what we refer to as a just and reasonable apportionment of the purchase price, and we would split the purchase price between three aspects. The first one being those fixtures and assets that qualify for capital allowances. So we would get a cost for those, do a calculation to work that out. And then we would also undertake a calculation of what does the rest of the building cost? So what does it cost to put that roof on, the windows, the floors, the substructure, etc. And we would also undertake a valuation for the bare site. So effectively the land that it sits on the assumption that that land, when you bought it, it was bare, had no buildings on, had services to the boundary, and it had planning permission for that type of a building. So if it's furnished holiday let, it had planning permission for a furnished holiday let of that type on there. And then that is put through what's referred to as the apportionment formula. So this is something that the valuation office agency recommends that we utilise when we're undertaking a capital allowances review. So we do all of that, and what that will then generate is a quantification of what capital allowances the client is potentially entitled to in respect of an acquisition. Where it's something that, say, the client has refurbished or converted or even built a furnished holiday let, we would try to extract the cost information from them. And as I've said, if that isn't available or it's in, not the right format, we would use the various techniques I've mentioned in order to work out what the value of the capital allowances is for the client. So this hopefully that answers your question.
Yeah, so this is very, very much a desk-based assessment.
We do site surveys of the property where needs be, but we don't have to be the only ones to do the site survey. These days, often furnished holiday lets are on a lovely booking site, and there's a lovely virtual tour. Yeah. So it's almost, we can, there's various ways, especially having just come out from lockdown and all the restrictions we had, there are various different methods we can utilise rather than, someone having to physically go and visit the property. Right. To work out what the assets are. So, we can look at sales particulars, we can look at virtual surveys, and, we also sometimes get clients to actually walk around with a phone and do a recording for us or send us photographs of certain parts of the building. Because sometimes, even where we do a site survey, if, for example, we're doing it of a property that's multiple let, we might not have had access to certain areas, or there might be quite sensitive areas at that point in time. So we might do a site survey, can't access some areas, but then we might ask, once the people are in those rooms, or you've taken out your sensitive data, if you could send us photographs, then we can work out what qualifies for capital allowances.
Yeah, so you see virtual tours in a different way, that you go around counting radiators and things like that.
You know what? Absolutely. When I look at virtual tour, I have a look at what are the mechanical electrical installations in that property, as opposed to, it looks absolutely glorious. I want to, I think that as well. I might want to spend a night there, but I do it from a very different perspective.
So when somebody has a furnished holiday let, and you do this kind of assessment, I mean, what's the typical value of a claim?
It can range. It depends on the precise nature of the specification of the property. So a higher spec property will have more value to it in respect of the costs that have been incurred on the qualifying fixtures that qualify for capital allowances. But I'd say, and there's various other things that impact a claim. For example, has a prior owner made a claim beforehand, would restrict the ability of a future or a current owner to claim. So we're probably looking at, on furnished holiday lets, anywhere between, say, 5% of a purchase price that you've paid up to maybe 35% as qualifying for capital allowances and tax relief. So it can be quite significant in some instances, depending on obviously the purchase price that is paid. Where a client has, say, refurbished an existing property, it can be up to the high 80%, and sometimes potentially 100% could qualify for capital allowances. Again, it depends on how much work they have undertaken in respect of structural elements versus maybe what we call like the softer elements, like the fittings and the finishings and the mechanical and electrical installations. So it can range, but there's a lot of scope there in order to maximize tax savings. And capital allowances are a non-contentious form of tax saving. They're akin to a personal allowance that everybody is entitled to. The only difference is, for capital allowances for businesses, you have to make a claim. If you don't make a claim, you don't benefit from the capital allowances. And it's worth pointing us out that the beauty of capital allowances are that if you still own an asset, it doesn't matter when you bought it, when you refurbished it or constructed it, and you haven't maximised your capital allowances claim, you are still able to claim that in a current period because you still own the asset. So I've gone back to the early 90s for some clients in reviewing property portfolios and maximising their capital allowances claims because they didn't need to claim previously. Maybe they were loss making, or they didn't just know about capital allowances to the extent that, you know, we do now. So there could be various reasons why claims haven't been made, but as long as you still own that asset and the point in time you make the claim, then you can make a claim for capital allowances and reduce the tax that you pay.
Okay. I mean, you know, in doing this introduction, I mean, we've talked an awful lot about furnished holiday lets, but where else do capital allowances apply?
So any commercial property effectively that is held as a fixed asset or as an investment. So this is quite a key point to reiterate, because some clients can have like mixed portfolios. So if you are effectively buying, building to sell, you're trading with that property, you do not benefit from any capital allowances. If you are buying or you're building to retain that property, either as a landlord, owner, occupier, or to utilise in your trade, and it's held as a fixed asset on your balance sheet, then you would claim capital allowances, because it must be, as the name suggests, capital expenditure, not trading expenditure. So any commercial property, so a list of those properties can be, sorry, I think the lights have just gone out, so I just need to move to put them back on, sorry. I do apologise. So a list of those properties, and this isn't exhaustive, can be anything from your offices, your restaurants, your hotels, student accommodation, care home providers, factories, industrial units, you know, MOT garages, car showrooms. Yeah, anything that has got a commercial element to it would qualify for capital allowances.
Okay. So what happens if say if you've got say a block of apartments, so there, and so a block of flats, so but they're residential flats, so the residential flats themselves wouldn't qualify.
Absolutely.
But if there was a communal stairway, lift system or something like that, would that element qualify?
It's a very good question. So this is quite interesting. So where you've got apartment blocks, like you've suggested, the apartments themselves are classed as residential dwellings unless they're furnished holiday let, they won't qualify. Whereas, as you've sort of mentioned, communal areas, the fixtures within those areas can qualify. And the reason for that is because they're classed as being commercial and not residential. So your lifts would qualify, for example, any carpets and mechanical electrical installations would qualify.
Okay. So and again, you know, we see more and more clients where they get, say, a block where they'll put in things like maybe a communal laundry or a gym, and even a communal lounge area. So would that's included in that?
It absolutely, yeah, it is. And I think a lot of the developments now where you've got apartment blocks, they're at that, what I'd say is the higher end. You get a lot more in the communal areas. It's not just typically you walk in the building, you go in a lift, or you go up some stairs. On the larger ones, they have all of those facilities. Some have like yoga gardens and all sorts of, you know, like residents only bars on the rooftop. So certain fixtures within those areas would qualify. And the same if they've got, like, say, basement car parks as well. There'll be some vehicle control, access control, lighting to the car parks as well. Those assets will also qualify for capital allowances. And you hit the nail on the head. Gyms, they have loads of equipment in gyms that qualify, and the same with laundry. All of the equipment within the laundry, you know, rooms and the machinery would qualify.
So it's worth exploring and having conversations with you with regard to these kinds of things.
It is, yeah, absolutely. So even where, say, clients have said, oh, my accountant's got that covered, or I've looked at this in the past and my accountant said there's not much there, or they've claimed everything. What accountants do is that they're generalists. They will do your accounts and your tax returns for you. What I deal with is the specialized area of capital allowances, and that's what I do in day out. But I do have regard for maybe your wider circumstances, your tax affairs. And it's what I've done for over, I want to say 19 years now. I've done this day in, day out. So it's effectively my bread and butter. So I know what I'm doing, and it's what I specialize in. Accountants probably would cover off the easy stuff, 80%, 90% of it. You know, so where they have maybe had a look at something, they may have reviewed a document when a property was bought and said, oh, you can't claim any capital allowances because I think you've agreed X, Y, and Z. And on the face of it, that might seem quite reasonable. However, I can do that extra digging and establish, could the vendor have claimed any capital allowances? So if you've acquired a property that was residential beforehand, or if it was acquired from, say, a non-taxpayer, or if it was bought from someone who owned the property prior to April 2008, there's an opportunity there for the buyer to potentially claim some capital allowances. And these are things that an accountant may miss out on, just simply because it's the nitty gritty and it's the finer details of the technical legislation that they won't be able to get into, because it's not what they do day in, day out, whereas that is something that I do. So absolutely, if a client has got any, you know, in this scenario, furnished holiday lets or a commercial property portfolio that they are holding as an investment, then it's worth having a chat to a capital allowance specialist such as myself in order to just review, what have you got in your portfolio? What could you have claimed, and what have you actually claimed? So what could be the potential extra upside for you from a tax relief perspective?
And so, but if you purchase a property, say a commercial property that you want to convert to, say, something like a furnished holiday let, or a property that's, say, previously been run as a furnished holiday let, is there anything to be aware of there?
There is. So this is a little bit of a minefield. So the legislation changed in April 2014, where if a vendor could have claimed capital allowances, and even if they did not, the only way the buyer can claim on those capital allowances that the vendor could have claimed upon is via what's referred to as a Section 118 election. So the Section 118 is a reference to the Capital Allowances 2001 Act. And what you have to do there is, within 2 years of buying that property effectively, you need to agree as a vendor and a purchaser what the price is that should be attributed to the capital allowances. Now, whilst you do have a 2-year time limit to do this, if you don't do it at the point of negotiating your contract or put some clauses into your purchase contract before you complete, once a buyer has handed over money to the vendor, they're gone. You know, doing whatever they want to do with that money and on to the next project potentially. So there's very little to incentivize them in order to retrospectively sign a Section 118 election. And also, if that vendor hasn't maximized their claim, they're within their time limits of their tax return to do that. So they might say, actually, we don't want to pass over any allowances to you. You can just get £1 or £2 worth and we will retain the benefit. So it's a little bit more tricky. So it's good to be clued up and know what you're doing when you're buying a property, and, you know, have a chat around what the capital allowance implications could be with a capital allowance specialist. When you are buying a commercial property, you will have some forms that are filled in as part of your sale and purchase process, and one of them is called the commercial property standard inquiries. So there's various forms of it, but there's always some capital allowance questions towards the end, and I have seen them filled in all manner of ways that are unacceptable, such as saying not applicable, not relevant, or the buyers to rely on their own inquiries, which is a little bit of a strange one, given that's what the commercial property standard inquiries are for. So they're not often filled in properly because, I guess, solicitors aren't tax advisors either, and they just take at face value what's passed over to them. And in some scenarios, clients can enter into elections that aren't for their benefit. And you know, you will get some scenarios where the vendor hasn't maximized the capital allowances, but nor has the buyer, but because then the buyer has agreed to something that prohibits them going forwards, potentially claiming on capital allowances as well.
Right.
I mean, if that scenario has happened, say we've got a client, they bought a furnished holiday let, that was already a furnished holiday let, they entered into a Section 118 election that wasn't to their benefit maybe, we can still have a look and check, did that vendor own that property prior to April 2008? Because in April 2008, a new category of allowances were introduced called integral features, which meant certain assets that didn't qualify for capital allowances post April 2008 now qualify, but that vendor could not have claimed those allowances, but a new buyer can, and you don't need to enter into a Section 198 election or anything in respect of those assets. So I'd say on purchases of properties, there are two opportunities potentially. One is if the vendor could have claimed, entering into a Section 198 election with the vendor to agree a value for those capital allowances so the buyer can claim the allowances, or if we're acting for a vendor, maximising those allowances so either the vendor can keep them and claim them going forwards even after they've sold the property, or quantifying what those capital allowances are and almost like packaging them up as part of the deal to buy the property and maybe monetising those allowances as well. And then the second opportunity is if the vendor did own the that's okay. If the vendor did own the property pre-April 2008, to sense check if there's an opportunity for the buyer to claim on those integral feature assets that the vendor could not have claimed. And as a rule of thumb, for the integral feature uplift, that's around about 5 to 10% maybe of the purchase price that could be available as capital allowances for the buyer. You know, it's a rule of thumb. It could be a little bit less, it could be a little bit more potentially in some circumstances.
So yeah, so buying this commercial property or buying say a property that's been run as a furnished holiday let can be a bit of a minefield. You've really got to you need to get the right advice to understand whether there are allowances that will apply or whether they've already been used.
Absolutely, you've hit the nail on the head there.
I mean, how many times do you find in these kind of circumstances that the previous owner, the vendor, hasn't actually claimed capital allowances?
It's a lot more than you would think. Often it seems, I don't know why, the vendors just maybe just didn't think they could claim capital allowances and it's never been really raised with them. So yeah, I'd say more often than not, we come across it where the vendor has not claimed capital allowances or has not maximised them. Funny enough, I was speaking to someone yesterday actually who's got 2 furnished holiday lets and they're selling one of them and they've never claimed any capital allowances. And on the one that they're selling, they actually had demolished the previous property and effectively built from the ground up a brand new property. So for me, that's something that was really easy. Wow. And I was like, yeah, you know, it wasn't complicated by they bought a property, a previous owner had owned, etc., etc. It was like, we built this from scratch. So I was like, well, you should have claimed the capital allowances. Why would you claim them? They just weren't aware. So because we've identified it, it's something that they can now consider as part of their sale process. Either they can retain those allowances and use it against their other furnished holiday let income that they're getting, or they can actually maybe think about, well, might sweeten the deal to actually sell this property as well, because it comes with effectively a value for reducing the buyer's profits from it, and not having to pay tax potentially on a certain amount. Yeah, so they're monetizing that, and they can pass that on as an incentive or as part of the purchase package. Yeah. So it is very, very important that, you know, that if you're running a property where there could be this commercial interest involved, that they speak to a specialist like yourself. Absolutely, yes. Yeah. Okay. No, it's been really interesting. I didn't realize that capital allowances were quite as complex and could be as maybe as contentious as you pointed out. Yes, they can be. You know, your bog standard laptops are really easily identifiable, but then anything that's to do with fixtures within a property, especially where you're buying or selling, it's fairly complicated. Okay, well, that's great. Well, so thanks very much for your time, Aulfat. What I'm going to do for everybody is put Aulfat's contact details in the comments below, and if you want to make any contacts, got any questions for her, then you can contact her directly. So thanks very much for your time. Thank you, Neil. And thanks everybody for listening, and we'll see you all again soon.